Welcome back to our final element of the first unit, in terms of videos, that is. A quick introduction into the corporate reporting framework. So, in essence, this is the domain that we're doing research on. So we try to understand how the corporate reporting affects transparency and how this transparency affects society, basically speaking. And for this, I think it's good to have a basic understanding of what this corporate reporting framework actually is. So if you're an accounting scholar, then you're doing research on this your whole life, basically. And this is why many accounting people become domain experts. So they are really knowledgeable about the legal environment that corporations face in different jurisdictions over time, different aspects that are involved in these legal designs. Good news is, if you're interested in corporate transparency work, you don't have to become an expert across all these questions, right? So you can pick and choose your certain focus. But whatever your focus is, I would strongly encourage you to become a domain expert in that focus. So if you want to do research on, let's say, consumer information, then please, by all means, familiarize yourself with the legal environment and the institutional details of this regulatory regime. And don't just do work on this, using some archival data without understanding the underlying rules and regulations, okay? So this was the disclaimer. And now, let's take a bird's eye view on all this. So this picture, I think I originally got from somebody at MIT, so I don't exactly know who created it. It's also a very simple picture, but I still like it regardless, because it summarizes really well what type of information we are thinking about here and what type of exchanges we are thinking about. So broadly speaking, when we talk about corporations, we think about a firm, right? So corporations is a more legalistic name for something that an economist would maybe just label a firm. A firm normally has exchange with contractual partners outside of the firm, so here simply labeled as outsiders. And the nature of this exchange is that often it is a little bit longer in terms of duration. So there are arm's length exchanges. So for example, when you go to the Späti and buy a beer, so if you don't know what a Späti is, ask somebody from Berlin, then normally this is a very quick exchange, right? So you go in, you get a beer, you go out, right? You exchange monetary units. But if you're an employee, then this exchange becomes a little bit longer in terms of duration. Or if you, let's say, if you are a supplier, or if you are a long-term customer in recurrent transactions, then obviously the transactions become more specific. So Williamson comes to mind, transaction cost theory. So meaning that these transactions become more special. Okay, and whenever you have transactions that are, let's say, longer, then this picture applies, because you have an exchange where you give resources early and you receive resources late. Yeah. So in principle here we focus on these type of transactions where the outsider is having a durational stake in the firm. So whenever you have exchanges like this, then of course there is a need, or there is a potential, let's say, demand for information. So this information can help to monitor these type of transactions. And when we talk about corporate transparency, then almost always we have a setting like this in mind, where there is a demand for information to facilitate, let's say, long-term contracting. And long-term doesn't mean it has to be years; it can also be weeks. Think about specific transactions. Okay, so this is what information is about. And when you think about the role of accounting here, so if it's labeled a picture of accounting. So when you think about what is the role of accounting here in this specific way, accounting structures and facilitates the information flow. So and there is a role of accounting, of course, also within organizations. This is not what we really focus on in this course. So this is more about, let's say, external reporting. Yeah. So, but here, as you see in this picture, it's really the role of accounting is to facilitate the information flow from the firm to its external stakeholders, the outsiders. Okay. So this is what accounting does. So now let's be a little bit more specific here. Now, when you look at this here from a let's say, a focus on the accounting transactions itself, then you can try to summarize this in a flowchart that looks something like this. I don't want to go in too much detail here because this is not a typical accounting class, obviously, but just so that you get an understanding of what we're talking about here. So the firm normally engages in a set of transactions. So transactions, you can think about transactions as contracts or exchanges, whatever. So they are in a large corporation, obviously, over a period, there will be millions of these transactions, but many of them are very recurrent, very standardized, so easy to summarize, but there will always be also very specific transactions. So for example, think about a merger and acquisition transaction that has a very unique nature and has a lot of informational value attached to it. So it would be good to know more about these specific transactions. So now, in order to separate, let's say, the recurrent standardized ones from the special ones, and to let's say summarize the information in a way that it becomes digestible for external parties, this is what accounting does, right? Accounting measures these transactions and summarizes these transactions and provides a standardized way of, let's say, talking about them, right? So these are what the accounting rules are. So what is important to understand, and for non-accountants, this might also be something that you don't really think about a lot. All these decisions that accounting, creates are normally being done by humans that work on behalf of the firm. So in our abstract sense, we talk about the management, and the management is taking these decisions on behalf of the firm. So obviously, as soon as this measurement process becomes a decision-based process, then our strategic components come into play. So it's no longer, let's say, a mechanistic measurement process. It becomes a strategic interaction. So a strategic interaction of managers that act on behalf of the firm. For most of this course, we will think about the firm as the manager, or so an owner-manager type firm, right? But there will be settings where we differentiate between the manager, the firm, and other maybe shareholders and other parties involved in the firm. Yeah? But I think what is important to take away from this discussion is that the reporting decision, so reporting, or let me put it that way, accounting requires judgment, judgment requires decisions, and decisions are strategic. So that means accounting is not a mechanistic measurement process, but a strategic choice. Okay, so now the outcome of this strategic choice can have multiple facets, but one thing that accountants are a little bit obsessed with is the actual annual report. So the annual report is an annual disclosure that in many jurisdictions firms have to make publicly available. So whether which type of firms have to make them available, and other details really vary a lot across jurisdictions. But in principle, you can say an annual report is the core outcome of this accounting process. And for publicly listed firms and for large private firms, normally this annual report has to be audited. So there we have another party coming into play. So there will be the auditor, again, strategic interaction. And then there is board oversight. So normally you have a board of directors that also contains outside directors, and this outside board is having a monitoring role, and the job of this board will be to oversee the annual reporting process and the auditing process, and then the whole thing is being disclosed. Sometimes there's another layer of regulatory oversight, also called as enforcement. Really, again, happens to vary across jurisdictions a lot. Again, and then ultimately the information from the annual report is being used by addressees, so the outsiders, right, of the last picture, for making decisions. And these decisions can be manifold. So, for example, investors can decide whether to buy a stock or to hold a stock. Suppliers can decide whether they want to deliver goods and services to the firm. Employees can take their employment decision. Public interest activists can decide whether to lobby against or in favor of a firm. All these decisions can be informed by accounting information, and they regularly are, right? So, besides the accounting information in the annual report per se, there are other ways, other channels of how accounting information is being disseminated to the public. So we will talk about these different channels in more detail in an upcoming unit with Beth Blankenswar. But here, I think it's also just important to understand that there are these different channels. So it's not just the annual report, there are also other means on how accounting-related information is being transported to the outsiders. And then there are these two little dashed lines here, which are easy to oversee, but they're very important. So the first one here just indicates that accounting information is not the only source of firm-level information that outsiders get. Yeah, obviously there are also alternative sources. We're gonna speak about them in a second in more detail. And here it's just important to keep them in mind, right? So they are there. And of course, whatever decision an individual takes is not only dependent on the firm level information, but also dependent on other information, here indicated as macro information. But of course, it could also be information about other firms, and it regularly is. So meaning that modeling the decision process of these individuals that have to take decisions on behalf of maybe a group or themselves, modeling these decisions is extremely hard, because it's not just based on one source of information, but there are all these alternative sources of information. And of course, we know that information interacts in decision making. Yeah, so and these aspects really become important when you want to understand how a certain piece of information can change behavior. So, and this is why I personally like this type of mind maps here, because it helps you to structure your thought process. So, for example, think about you having the task to design a certain, let's say, reporting regime, and then you have the objective to create this regime in a way so that shareholders can make informed decisions about their investment, for example. In order to do this job, you need to understand not only your own regulatory regime that you are focusing on, but also the other information that is available to your decision makers. Yeah? Because obviously the type of decision that they will be taking and the efficiency with which they can take these decisions will depend on their whole information set, not just on the regime that you are designing. Okay? So this is what I wanted to show you with this little picture. And now we're going to turn over to these other information errors here, right? So besides financial accounting, yeah. So what else is out there? And the answer is a lot. And for me, this is an entirely fascinating area to think about. So over the years and decades, the information environment about corporates really exploded, right? So when I was doing my undergrad studies, firm level information, there wasn't that much. There was basically the traditional accounting information. There was a little bit of analysts running around, financial analysts, but to be frank, in the German domain, in the 90s, there was a little bit, in 2000s, there was a little bit underdeveloped, right? So, and then there was the media, okay? And that was basically it. And the media, when we talk about media in the old days, these were basically one or two newspapers, right? So very limited information environment when it comes to publicly available information. Private information, of course, is a completely different thing. So when you think about private information, you can think about all these networks of people that communicate with each other. Yeah, so the famous infamous Deutschland AG, that back then were these close social ties that you observe between organizations and how they interact. But here we are focusing on public information, okay? So now you see this wonderful slide and you maybe start to wonder, what are all these icons? What do they stand for? And I thought that I'm doing a little bit of a game with you here, also to encounter you, maybe to discuss things, on GitHub or YouTube or Moodle, whatever. Here we have some pictures, and some of these pictures are self-explanatory, so you can read them. For example, Glassdoor. I guess most of you guys are familiar with Glassdoor. It is an internet company that provides information about jobs and employment positions, and where the unique feature is that employees can actually talk about and value their companies and their positions. So it provides an information environment, an information platform for employee-related corporate information, right? So this is something that, of course, did not exist 20 years ago. And this is an entirely new resource of information that is important to many stakeholders. And then, of course, I guess most of you see the logo of the Wall Street Journal here. So Wall Street Journal as an example for a traditional media outlet that focuses on corporate information. And you also see in the top left, you see the U.S. Securities and Exchange Commission. So you might say, okay, the U.S. Securities and Exchange Commission, so the task of the SEC is to oversee the capital markets, the U.S. nationwide capital markets. You see that this SEC also has the role to monitor and supervise the accounting and traditional corporate reporting level. But when you think about the disclosure system of the SEC in more detail, you will see that this is much broader than just, let's say, the traditional financial information that corporate reporting generates. It also contains additional information sources, like, for example, the ownership levels in companies, right? And other aspects that are being disclosed via the SEC. And then you see, for example, the GRI, the Global Reporting Initiative, and other logos that are related to non-financial information, so sustainability reporting, CSR reporting. And you see NGO initiatives like Transparency International or the Tax Justice Network that also relate to corporate reporting and transparency. And of course, you see Twitter as a logo for so the let's say social media type of information exchanges, which are interesting. But then you also see some maybe to the lower right you see two. Let me do that one as well. The ECCNet and the Federal Trade Commission. So the Federal Trade Commission is a U.S. agency that supports and provides information to consumers, and the ECCNet is a network of European consumer centers, so with the same objective basically, but in Europe these are national organizations mostly. I included these two because they provide interesting firm-related information that is geared towards the consumer, right? So also an interesting outlet of information. So and now there are some icons which I didn't explain. Yeah. So the little game here is, if you're interested, figure out what these are. Right. So you see this little jar, you see the OC thing, you see the alpha, and you see this globe. Right. I think these are the ones that I didn't really talk about. And you see this guy looking towards you and mad, right? Mad money. Well, this is easy. But anyhow, so if you have an idea of what these institutions are, maybe write it into the comments, and maybe also, if you know them, say a word or two about whether you like them or not, or what you think about them. I just included them here so that you see how broad and how rich this information environment is. Yeah, and this means that it's also exciting to think about these information environments and what roles they take within the whole corporate transparency framework. Let me put it that way, right? So if you want to do research in that area and you're not an accountant, then there's no need to worry, because there are so many information organizations and institutions that you can study where you don't need to have all these nitty-gritty domain knowledge in accounting. You can simply look at them from a more economic perspective and just understand how they affect exchange at the global level. Okay? And now the last bit that I wanted to talk about in this video is, what is the effect of transparency on economic performance or welfare, or however you want to define it, at a somewhat broader level? And for that, I use a visual that is included in a what I think very nice overview article by Rob Bushman and Annie Smith, published in the Economic Policy Review of the New York Fed. It's a little bit older, like 2003, but I think it's still worth reading. You will find it on the net quickly. And what I like about this little survey is that it tries to structure a little bit the channels by which information can affect economic outcomes. Okay, and I like these three channels. So there are different ways on how you can classify this, but for me, this is really, I like this structure. I think I said it 3 times now. Okay, let's start with the first channel. So what you see here is this dashed rectangle. This is all the information that is out there about firms. It's the information environment, as they call it. So it contains, of course, the traditional accounting information. You see unaudited disclosures and stock price and information collected by private investors. So alternative information is also included here. So think about this as the information environment that you have about a firm. And then you have these 3 channels. So the first channel is simply the idea that if you are better informed, you can make better resource allocation decisions. And this applies both to the manager, so to the firm itself. So if the firm has richer information about itself, it can make better informed decisions. Okay, and also to investors, right? So investors actually they make financing decisions, so they provide financing to a firm, and if the investors are better informed, they can make better informed financing decisions, and this normally leads to more efficient investment, higher welfare, higher economic performance. Okay, so that's channel 1. It's a very straightforward channel. If you know what you're doing, you take better decisions, right? So you can also think about this in a typical Akerlof framework. So market for lemons idea. If you have better informations, then you make better decisions. So the next channel here, channel 2, is closely related, but speaks to the question of once you have made an investment decision, how can you make sure that this investment decision is actually being carried out in an efficient way? So this is very much about moral hazard, right? So the channel 2 idea is if you have a rich information set, it is easier for you to monitor management maybe as an owner, and to make sure that the delegation of authority that you provide to the manager is not creating too much efficiency losses. Yeah, so you can come closer to first best if you want. In a richer information environment, this gives you the opportunity to have better governance, and better governance, of course, increases economic performance, right? And then there is the third channel. So the third channel is a little bit more subtle, maybe, but think about the third channel as a channel that surfaces when you have a secondary market where, for example, ownership claims in a firm are being traded. Let's assume that you are an owner of a privately held company and you want to diversify your portfolio and you want to sell off part of your assets on a secondary market. So this is relatively hard for you because you have to find somebody who's willing to buy your stakes at a reasonable price. And this is hard because there are these informational frictions. So these other parties will most likely assume that they are at an informational disadvantage to you, right? Because you are the entrepreneur, you know everything about the firm, right? So and that means that you run into another layer of the Akerlof problem, right? The market for lemon problem. Now it's no longer the within firm type of problem, but it's the secondary market type of problem. So meaning that you as an owner that wants to sell off part of your stakes to other investors, yeah. So in this investment market, you face again adverse selection because of limited information. Okay, and if you make this secondary market more transparent, then also this market can become more efficient, and of course this is beneficiary again because it reduces the cost of capital for these firms, and then it becomes easier for these firms to finance themselves, and the market can screen better, so the good firms can survive, the bad firms can leave the market. Also this increases economic performance. So this third channel, as I said, here it's been explained, and I explained it from the perspective of investors. But in principle, this channel is also available for other stakeholders. So think about, for example, employers, so labor. Yeah, think about the labor market. So on the labor market, you also have this problem that maybe employees of a given firm, it's relatively hard for them to change jobs, to find other jobs, because they don't know much about the employment opportunities of other firms. And also maybe some employers find it hard to actually find new employees, because it's hard for them to communicate with these employees about the qualities of the job. So when you have a very transparent employment market, so think about Glassdoor, right? So then maybe it is easier for employees also to swap jobs, to change jobs around from one position to another, and this could increase the efficiency of the labor market by reducing the information asymmetry across or between employees. Okay, so this is just an example of how you can think about these different channels in economic terms. So what I like about this is that it serves as a framework with which you can understand the different problems that you face in corporate transparency. Yeah? So whenever you have a question that involves corporates or firms, then it really becomes crucial to think about the informational problems that you have in your setting. Yeah, so, and this relates to all exchanges that firms are involved in, not just the capital market. So labor market, product market, the environment, all of these aspects or facets of the economic life of firms and corporations are affected by the informational frictions. And this is what this research program is all about. Yeah, so a lot of exciting questions to explore. And this is why I'm very much looking forward to Christian's talk on Monday. So please remember that you can send in questions that you would like Christian to address. You have to do it by Wednesday. And if you're seeing this later than Wednesday, tough luck. But as I said, thank you for listening. Looking forward to meeting you on Monday, and enjoy. Cheers, bye.